Welcome everyone. My name is Vinnie Brown. I'm a real estate agent and interior designer with Coldwell Banker, and I'm here today with Lori Roberts.
Thanks for having me, Vinnie. I'm with Guaranteed Rate Affinity, and I have been in the business for about 35 years.
A very long time.
Yes.
And Lori and I do a lot of loans together, so we are hoping that there's going to be a lot of information that you will enjoy. Today we're going to do a series of videos about navigating the crazy home buying world and getting a loan. We have come off of a crazy run in real estate where prices in Cincinnati jumped 24% at some point, then came back down to 14%. And now where I think we're going to go is we're going to see a more stabilized market. So we're going to be probably back to 6% year after year real estate, and so your investment will increase 6% year after year like it used to be back in the good old days of real estate. I think we're going to see a stabilized buying and selling. Our clients that are buyers and sellers are going to be on equal footing for the first time in a really long time. This market has been crazy. We had low interest rates. We're starting to see that creep up. We're going to get to that in another video. We saw houses being bought and sold with no inspections, appraisals being waived. It was really intense for a while and scary for buyers. I think we're going to see that stabilize a little, so that's always a good thing. So now is not the time to get out of the market because there's all this doom and gloom in the press. But again, this is not the time to get out. If anything, it's a time to get in, and we're going to talk about that with Lori. So Lori, what do you think happened this past couple of years?
Well, I agree with you, Vinnie. I mean, it has been that fear of missing out. And right now, I think what we're seeing, as you said, more of a balancing of the market, where we're getting back to more of our norm. Mm-hmm. And yet the media likes to talk bad news sells, and we in Cincinnati, we're not worried about values coming down. We're not worried about the investment because we're just going to get back to more of a normal balanced market. And I agree, it is not the time to be stepping out of buying. This is a wonderful time to get back in. And rates have climbed up, and there's been a little bit of a sticker shock because they were artificially held down by the Fed. And we're starting to see that ease up, and we're moving into more of a normal. I think what I've seen is it's moved much faster than we normally would see. And so there's a little bit of sticker shock, but it's still, I've been in the business a long time, and these are great rates. These are not bad rates.
Yeah, it's so weird. I was talking to somebody the other day. I bought my first house in 1994, and I had a 6.8% mortgage rate, and I thought I hit the lotto. So I do see it's more stable now, right? So let's talk about renting versus owning. And I think you have an amazing graphic that shows this.
I do. I mean, what I put in this graphic is we're highlighting a $275,000 sales price, which puts a mortgage payment at about just a little under $2,000. And I'm comparing it to a $2,030 a month rent. That's including the renter's insurance at $30 a month. And looking at it over a 9-year period, if you rented for those 9 years and we're taking into account an increase of rent at a normal, maybe 6% increase in rate in the rent, but over 9 years, you would pay over $300,000 in rent, and you're not building any wealth there. Versus purchasing a home at $275,000. At the end of 9 years, we're looking at a value of a little over $400,000, which is, we're considering like a 4% increase in value, which I think from talking with you, Vinnie, is more than 6% in our area. Mm-hmm. And that would, over that 9-year period of time, looking at the rent where you would have paid over $300,000, at the end of 9 years, you actually, as a homeowner, would come out with about a $224,000 increase in your net worth. And that's taking in consideration the down payment, initial investment, the commission to sell that property down the road, and the maintenance over those years. And you're still coming out with a a net worth that most people will not see if they're investing in the stock market.
It's a great way to build wealth, is exactly what you said. And not only that, the rents in Cincinnati are crazy right now. We're number 6 in the country for increased rents.
I know, which is insane. I mean, we're right up there with Los Angeles and New York. That's not where we normally are, but that's what we're seeing. And when you can make an investment in yourself by purchasing a home, that just helps. It gets you a foothold that you just aren't going to get anywhere else,
right,
versus helping someone else gain their net worth.
Right, and most of us get a tax benefit also.
That's right. Most people are going to be able to deduct some of the mortgage interest and the real estate taxes. So again, another win in homeownership versus renting. Credit is really a management of showing your risk level. How do you manage your credit? It also shows your ability to repay the loan. So it's a necessary evil. We like to tell people, you need to have credit, but please don't overuse it. And there are 5 components to building your credit. And first one that we all think about is paying on time. But it's also managing your balances. So if you have a credit card with a $1,000 limit, we really don't want, when that next bill comes out, having you utilizing more than $400 of that. And what that means is you're going to get the most bang for your buck on your credit score if you stay at that 40% utilization. So what I suggest doing is, if you make a large purchase and you get almost to the limit, we don't want it to look like that on the credit report, so it looks like you're not managing your credit. We want you to pay that before that bill comes due. The worst case is, in 60 days, it'll reset to your normal score. But if you're in the middle of purchasing a home, that could be a problem. So we want to, keep an eye on that. The other part of credit is length of credit history, which for our younger buyers can be kind of difficult. So really suggest starting early, maybe parents putting you on their credit card to help build that credit rating. So length of credit history, payment history, and mix of credit can have a big factor. So, and of course, payments.
So, yeah, you have to make your credit card payments. And I took a big hit on my credit one time because I paid for something large and thought I'd pay it off, obviously the next month, but I hit over that 40% that I didn't realize, and I took a huge hit on my credit. So it really is something you have to think about and manage, and especially, like you said, when you're going to buy a house.
Timing.
Don't do anything outside of the norm. But I find it interesting, you have to have credit to build credit to get a better credit score. What about people that pay cash?
It's fine to pay cash if you plan to pay cash for everything. If you never plan to finance a car, if you never plan to purchase a home, or if you do, it's all going to be cash. What I suggest is, if you're starting off and you've either had a bump in your credit or you've not used credit, it can be hard to get someone to want to give you credit.
Right.
So I suggest a secured credit card with your local bank. And what you do is give them money that they hold for the security of that credit card. And then as you use it, they will report to the credit bureaus. So there's no risk for the bank that you're going to default, because they've got your money held there. But you can build credit, and then you can move away from that and close. I would suggest not closing out an account until you've built more history, because that too can drop your credit score. There's so many mysteries, but if you talk to someone who you trust that can help navigate you through that, it's very important. And it's also you can get a free annual credit report where you can see what's on there.
Which is a great idea to do. I did that, and I found I had all this stuff on there that I didn't even realize. I had credit cards that I thought I had closed but weren't closed out on my credit, so that's a great idea. So what about someone who has bad credit? I know there's a lot of credit counselors out there. What do you think about that?
Well, the bad credit, I think it can happen to any one of us. You're young, life happens to you, and there are ways to come back from that. But you're right, there are credit counseling agencies out there. My opinion is you're paying them to do something that you can actually do on your own. And that would be some of the things we talked about. But it's if there's negative history there, address it. reach out to if you have a collection, reach out to them, get into a repayment or get it paid so that it doesn't report every month and continue to pull down your score.
I want to talk today about student loans. It is a crazy topic in the media right now, and I know it is a huge stressor for a lot of my buyers. So talk to us about how that's calculated.
Absolutely, and it is. It is a difficult topic, and student loans can be a mortgage payment. And way a lender looks at student loans is on a credit report. It's going to look at the balance, and if there's a payment, that's what's going to be used to qualify for a mortgage. If there's no payment, if the loan is in deferment, which majority of them still are right now, we would either, depending on the type of loan, either use 0.5% as a mortgage, as a payment for that student loan, or 1% of the balance. And in some cases, if you've got a $300,000 loan, that's a lot of money. So another suggestion I have is going to your student loan lender and doing an income-based repayment plan. And that can really lower the payment. And once we have that in writing, we can use that. The other thing is parents signing on these student loans. It can hurt parents trying to purchase a home. And if we can document that your child has been making those payments for the last 12 months, then we don't have to count it against you, even though you may be co-signed on that. So I think that's an important piece because it is affecting young people and people that are trying to retire. It is it's a major issue these days, but there's ways to get around it.
Is there any way people can consolidate their loans?
Yes, you can, and that can make a difference in the payment as well. One thing that we do see sometimes is when you're in the process of consolidating, before they get completely consolidated, sometimes a late payment can happen on the original loan. So what I suggest is just watch your credit so that you can catch it if something like that happens before it's a year or two down the road.
So I always have clients asking about buying a house after a divorce. So talk us through that.
First thing I would say is when something like that is going on, to talk to you, reach out to me, so that we can make a plan ahead of time. I think it's really important when you are getting a divorce, let's start with that, is if you have joint credit, to figure out before you finalize everything, who's taking care of what, and that it's in writing. If there are joint accounts that can be closed or paid off, it would be a great idea because you can, even if you're not the one required to make those payments and that other person isn't paying, it can have many year issues on your credit. So get that straightened out. Also, if it's in writing, then we can refer back as a lender. We can refer back to that written recorded decree of who was responsible, so that we don't have to count that debt against you. The other piece is income. Where do we get the income to qualify you when you've recently gone through a divorce?
Okay.
And alimony and child support can be used. It just has to be ongoing for at least 3 years for us to use it. And if you're recently divorced, we want to see for one loan, we need to see at least 3 months of receipt. And for a conventional type of loan, it's going to be 6 months of receipt.
Now, on the opposite side of that, your alimony and child support is a debt to you as well, correct?
It absolutely is.
Okay. So they have to take that into consideration in your debt ratio?
Yes.
But basically, you're saying just get everything in writing. Make sure that you have it in the divorce decree, who is responsible for what, and then...
Yeah, and just kind of make sure you're protecting yourself.
Okay, so now...
Ideally, you separate that credit.
Yeah. Okay, so now let's talk about bankruptcy. People are always afraid they can't come back from it, but they can.
They can. I mean, life happens to all of us. And just like credit, as we talked about credit, it's about reestablishing your credit risk and having some new credit after it happens and just rebuilding from there, and that the lender can look at it, and as soon as 2 years afterwards, you could purchase a home.
So it's 2 years. It used to, I mean, we always heard it was 7 years. You have to
Right.
rent for 7 years, but it's 2 years.
2 years, and
Wow.
you're able to do an FHA loan. Life happens to people, for multiple reasons, and you can build forward from that. Health has come into a big issue and can create bankruptcies.
Yeah.
So again, just rebuilding that credit history and showing that you're a good risk, that things have happened, but things, you're moving forward.
What about medical bills? Does that count against you as well? Is it a percentage or?
Well, yes, it is. As long as it's under 2,000, we're not going to have to count it. If you're in a repayment of it, we would use that repayment amount to qualify you for the loan.
Now we're going to get into the interesting part, interest rates.
Yes, there's a lot of news in the media. Media likes doom and gloom, and interest rates. Let's talk about when we're hearing all the time about the Fed and the rising rates.
Yes, let's start from the beginning, because
Yes.
a lot of people just don't even understand where an interest rate comes from and how it affects the mortgage rate.
Yes. Well, the Fed, when they're talking about rising rates, it's the cost to borrow funds, which is more for businesses, for your credit cards, your car loans, a home equity line of credit. Those will be directly affected. The mortgage rate is tied to the bond market. And when the Fed when the Fed right now is trying to control inflation, and that is what really hurts mortgage rates. And so as the Fed raises rates, it actually can help the mortgage rates, because we're seeing control over that inflation, that we can maybe get that away from where it has been. And that will actually help mortgage rates. So it's not all doom and gloom.
Which is funny, because everybody is like, oh, put the brakes on buying a house because the interest rate is so high. But it's actually not. You're saying it's a fallacy.
It is. The media actually sits there on the news and tells you mortgage rates are rising because the Fed raised rates. Not true.
Okay.
And I want to scream at the TV when they do that. But it does have an impact. And we have seen rates rise. But that's more to do with the artificial holding down of rates because of COVID.
Okay.
And that was a once in a lifetime thing, or at least we hope so, right?
Right. Okay, so how do you determine, as my loan officer, what my personal interest rate is going to be when they're all over the place?
Well, a lot goes into that interest rate. The amount of money that you're putting down can have a determination on it. Your credit scores are a big piece of it. And if you're putting less than 20% down, your credit score actually has a bigger impact on your mortgage insurance. So those are all factors that go into that rate. And a lot of people like to shop on the internet for interest rates, like they do realtors. And I like to say one size does not fit all. That shopping for an interest rate on the internet is like shopping for shoes on the internet. You kind of really need to try them on for size, and that means, I think, someone local.
Well, local is a big thing. As a realtor, we love dealing with local loan officers, because otherwise you don't get anybody on the phone that's going to talk to you about what's going on. And I definitely think that that's the case.
You're not a number.
No.
You're a person.
Yes.
And Vinny, you know where to find me, or whoever else you're working with. There's that accountability to the client and to you. We do have 3 types of loans, and there's more out there, but 3 main types of loans are the conventional loan, the FHA loan, and the VA loan. And conventional is majority of the loans that we see. FHA is a little more lenient on bumps in credit history. It's more lenient on debt ratios. And then VA are for our veterans. And that's 100% financing, no mortgage insurance, which if you qualify for that, it's a huge thank you from all of us for your service.
So 100% means 0 down payment.
Exactly.
Okay. And now a conventional loan, most people think it's 20% down. So talk a little bit about the difference in even conventional loans as far as down payments.
Very good point. A conventional loan, you can actually put as little as 3% down if you're a first-time home buyer. 5%, 10%, 15%, 20%. And if you put down more, it actually can help your interest rate as well. But there are a lot of options out there. So it's not always one size fits all. It's helping your client find what's the right fit for them at this time in their life.
Okay, so now we have our credit in order. We have figured out our down payment and what loan we're going to go with. Now, how do we get that process started with, let's talk about pre-approval versus pre-qualification?
Great question. Pre-qualification is what you and I are doing right here. It's a discussion. You're telling me my credit score's perfect. My income is $100,000. My debts are $1,000 per month. And I can pre-qualify you for a mortgage based on that conversation. But to write an offer on a property, that pre-qualification won't work. A pre-approval is what you need. And a pre-approval is where either you do it online or we do it together on the phone or meet in person. And we enter in your income, your job, your down payment, and we pull your credit. And along with that, you're going to supply documentation to support your funds for down payment, your pay stubs, your W-2s, if you're self-employed, your tax returns. So I have something physical to base the decision off of. So we have all of that, then we run a computer approval. And that will tell us whether the loan's approvable or not. And things that can hold back an approval are, most of the time, it's not being able to verify the income or a credit issue. But from there, I would say a lot of people think, well, good, I'm pre-approved and I can get a loan. Well, there are certain things you need to continue to do once you're pre-approved, and that is continue to pay. Want to keep that pre-approval, want to be able to close on your loan, keep your credit the same. Don't open up any new credit. Let's keep things as close as we can to what they were.
Don't buy a car.
Thank you. How many times have you had that happen?
Oh my gosh, don't buy a car. I went to a closing and somebody bought the car the day before we closed.
That changes things.
That changes
and they may
everything.
still be able to get the loan,
Right.
but it's going to delay things. So try and keep everything the same. And if you have something you need to change, like a job, okay, that could happen. We prefer it not to, because that again can delay.
Right.
But check with, let your lender know of anything coming up that you need to discuss. Don't just do it and say, oh yeah, did that matter? It can make or break your purchase, and we are not in the business of breaking hearts.
Yes.
So try and work with your communication.
Yeah. So first thing for me as a realtor is I'm going to come to you and just send you my client, and you're going to tell them what they can afford based on the initial basic information that they've given you. Then when we go to write the loan, that's when we need the pre-approval. And that's what you do, and you do it so well. So as always, great information. Thank you so much. And if you have any other questions for Lori or I, our information is on the screen. We're going to answer all your questions about credit, interest rates, getting your finances in order, everything you need to know about buying a home.